Bismillahirrahmanirrahim. This is the third video on risk analysis. And in this video, we will discuss how to analyze financial flexibility by disaggregating return on capital employed. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. Financial flexibility lets companies use debt wisely to possibly boost shareholders' return. This depends on ensuring returns on assets are higher than debt cost, thereby creating value through smart capital structure management. Let's simplify the key points regarding the disaggregation of return on capital employed and the effect of increasing leverage on common equity shareholders. So, return on capital employed can be broken down into three components. First is the profit margin, it measures the profitability. The second is the assets turnover, it measures efficiency in asset utilization. And finally, the financial leverage that measures the impact of debt financing on returns. However, while increasing leverage can boost returns for common equity shareholders through financial leverage, it also introduces challenges such as the time lag in deploying funds effectively, reducing profit margins due to higher interest expenses, and increased demand on future cash flows. So, this approach has a limitation as it doesn't directly show how much a firm can increase leverage to benefit common shareholders without hurting profitability, known as financial flexibility. These factors must be carefully managed to ensure sustainable growth and shareholder value creation. So let us talk about an alternative to disaggregation proposal. Now, while reformulating the financial statement, separate items are going to be recorded into operating, that is related to daily operations, and financing categories to clarify the impact of operating decisions versus financing or financial decisions. Like assets are split into operating assets used in daily operations and financing assets like investments. Similarly, liabilities are divided into operating liabilities, example accounts payable, and financing liabilities, example long term debt. Equity is analyzed considering its financing implications. The purpose of reformulation is to enhance an understanding of financial flexibility by refining return on capital employed disaggregation. It helps to evaluate how leverage adjustments can enhance returns for common shareholders while maintaining profitability. So, this approach provides a clearer view of how a firm can strategically manage leverage to benefit shareholders without compromising profitability, termed as financial flexibility. The key task in balance sheet reformulation is categorizing assets and liabilities into either operating or financing categories. Operating assets and liabilities are essential rather for the day-to-day operations of a company. These include things like inventory, accounts receivable, and accounts payable. Financial assets and liabilities, on the other hand, are sources of capital um, that fund these operating assets. Examples include loans, bonds, and equity investments. In essence, operating items are directly tied to running the business, while financial items are related to how the business finances its operations. Regarding non controlling interests, they are often treated similarly to preferred equity as financing obligations and are viewed from an equity holder's perspective. However, some analysts argue they should be netted against operating assets instead. Just a word of caution: consistency in treatment on the income statement is key, whether they are considered financing or impact operating assets. So, net operating assets is equal to net financing obligations plus common equity. In the financial statement reformulation, operating liabilities are matched against operating assets. These include financing liabilities, financing assets, and common equity on the right hand side of the equation. As already stated, non controlling interest and preferred equity are categorized under financing obligations separate from common equity. So, while these adjustments alter totals compared to traditional balance sheets, the equation remains balanced. Financial assets like cash, marketable securities, and investments must be categorized as operating or financing based on their intended use. Cash and securities used for daily operations are considered operating assets, while investments in affiliates are tied to operational needs. Certain financial assets are specifically reserved for companies' financial structure, such as funds for debt retirement or bond sinking funds. These are offset against financing obligations to calculate net financing obligations, similar to how operating liabilities are offset against operating assets to determine net operating assets. Determining the treatment of cash is crucial as all firms require working capital in cash, but excess cash is subjective and depends on the firm's reasons for holding it. There is no universal formula for defining excess cash, requiring a thoughtful assessment of the firm's unique circumstances. I would like to introduce the concept of negative net financing obligations. In the year 2004, investors uh, criticized Microsoft for holding too much cash. By the year end, their cash and short term investments totaled 60 billion, which was two-thirds of their total assets amounting to 94 billion. To address this issue, Microsoft paid a special dividend of 3 per share, totaling 33 billion, and planned a 30 billion stock buyback. It was difficult to pinpoint the exact amount of excess cash Microsoft held, but any estimate would have shown that Microsoft had negative net financing obligations because they had no debt at that time. However, having negative net financing obligations is acceptable as long as the income statement's structure aligns consistently with how assets and liabilities are classified as operating or financing components. Once we reformulate the income statement, each item is categorized as either operating or financing for reported profitability. After adjusting the balance sheet, it is clear how each income statement item relates to operating or financing activities. Items designated as financing assets or liabilities affect the income statement accordingly. For example, interest income relates to financing assets, while interest expense corresponds to financing liabilities. Preferred equity is classified as a financing liability, so dividends on preferred shares are treated as financing cost. Similarly, non controlling interests are categorized as financing liabilities, making income attributable to these interests also viewed as a financing cost. So, now let us look into the reformulated balance sheet for Starbucks. And you can see we have the consolidated balance sheet and we have the reformulated balance sheet, and we are going to talk about it for a while. Now in the reformulated balance sheet you can see that all cash, cash equivalent and short term investments are categorized as operating assets, assuming they are not used for financing purposes. This means all of Starbucks assets are considered operating assets. By subtracting the current liabilities and other long term liabilities, excluding the long term debt from these operating assets, we get net operating assets for the year 2012, 13, 14, 15, as you can see. For the year 2015, the net operating assets was 8,163.7 million, whereas the total assets reported on the balance sheet was 12,446.1. Let us look into the income statement for Starbucks. We have once again we have the consolidated statement and we have the reformulated income statement, and that shows that the costs are over here are related to financing. These costs include interest expense and earnings attributable to non-controlling interest. So if Starbucks has preferred stock, preferred dividend would also be counted as financing cost. Everything else on the income statement is part of the operating profit. So after subtracting the taxes from operating profit, uh, we get net operating profit after taxes, and this is also known as EBIAT, the earning before interest and after taxes. So NOPAT and EBIAT essentially means the same thing when operating and financing activities are treated correctly along with proper tax treatment. The reformulated income statement splits Starbucks tax provisions between NOPAT and and net financing expenses. For the year 2015, Starbucks has reported a total tax provision of 1,143.7 million. This is for the year 2015. However, the reformulated statement shows a tax provision of 1,164. on the operating profit before taxes. This higher tax provision in the reformulated statement happens because interest expenses is excluded from the income before taxes. You can see this is calculated as 20 effective tax rate, that is 29.3% times income before income taxes, that is how much? So that is 3973, 3973.5, where this 29.3% is the effective tax rate, and that is the income tax expense of 1143.7 divided by the earnings before taxes of 3903. So when you solve, this will be 29.3%, and you can calculate the same for 2014 or 15 as well. Now the tax benefits from interest expense is reduced. You can see over here the effective interest expense from 70.5 million to 49.8 million between the reported tax provisions and the adjusted provision. This reflects the tax benefits from using debt and tax deductible interest. Had Starbucks classified its long term investments as financial assets, they would have been offset against financing obligations. So, to maintain consistency, interest revenues after tax from short term investments would also offset interest expense after tax to calculate net financing expense after tax. With this approach, the balance sheet would still balance, although the totals would differ. Similarly, the income statements would reflect the same net income available to common shareholders, but how operating and financing components are allocated would change. So, non controlling interest are treated similarly, categorized as part of financing obligations, and their share of net income is included in net financing expense. Let us illustrate how return on capital employed is broken down into operating and financing components using these revised financial statement classifications. Now, operating return on asset measures the return a firm earns on its net operating assets, that is NOPAT, NOPAT divided by net operating assets, covering returns to debt, preferred equity, and common equity. This differs from traditional return on asset, which uses total assets, that is, it adds leverage and spreads as factors. Now, leverage is total financing of financial obligations uh, uh, divided by the common equity, including debt, preferred equity, and non controlling interest. Spread is the difference between operating return on asset and the net borrowing rate, incorporating interest and preferred dividends as well. A higher spread suggests borrowing could benefit common equity shareholders more. Operating return on asset breaks down into profit margin and net operating assets turnover, similar to return on asset. Profit margin for operating return on asset multiplied by turnover gives operating return on asset. Financial flexibility refers to a company's ability to use debt strategically for opportunities or expenses. Low flexibility arises from high debt, cost, or insufficient cash flow. High flexibility allows easier, cheaper capital access for profitable investments. Spread is key in financial flexibility, showing returns versus borrowing cost difference. Larger spreads let companies borrow cheaply, investing in high return assets for common equity gain. Increased leverage raises borrowing cost, impacting rates and benefits despite spreads. Strategic factors like market saturation affect flexibility. High operating return on asset versus cost suggest greater flexibility and lower solvency risk, both short and long term. So, let us look into an exercise that can help us to understand the difference better. So, here we have the consolidated balance sheet, we have the reformulated balance sheet, and we have the reformulated income statement for Starbucks. First of all, we will go for the standard return on capital decomposition, and first one is the profit margin ratio, that is net income to common equity or called to shareholders divided by sales. Now, so we I put this as A. So for A, the net income for, and I will be making these calculations for the year 2015. So the net income to common shareholders is 27,757.4 million, and this will be divided by sales or the net sales, that is 19,162.7. So this will be equal to 14.39%. So for the year 2015, it will be 14.39%. For the year 2014, you can calculate the same way, it will be 12.58%. For 2013, it will be 0.06%. Coming to the second one, B, that is assets turnover. So for assets turnover, that is sales, again I am doing it for the year 2015 only. So sales is 19,162.7 divided by average total assets. Now if we have, so now we have the total assets in the consolidated balance sheet, that is because we have to take the average, so we take the total assets for 2014 and 2015. For 2015, so that is 10,752.9 plus 12,446.1, and because this is average, we have to multiply by zero point 0.5 as well, and this will be equal to 1.65 times. So this is 1.65, this will be 1.48, and this will be 1.51. Next, we are going to calculate the capital structure leverage, and we put this as C. For the capital structure leverage, we have the average total asset, the same that we have over here. So that is 0.5 times 10752.9 plus 12,446.1, and this will be divided by the average common equity minus non-controlling interest. So we have the common equity over here, that is 5272, plus 5818 and this will be multiplied by zero point 0.5. Let me, and this will be equal to 2.09. So for the capital leverage, it is for the year 2015, it is 2.09. You can calculate the same way for 2014, 2.28, and 2013, 2.06. Finally, we come to return on capital employed, and that is net income to common equity. And the net income is for again this is D now. So for D, we have net income to common equity, that is 2757.4, 2757.4, and this will be divided by average common equity, that is the same. We have that is 5272 plus 5818, and this will be multiplied by 0.5, or you can just divide by 2, it makes the same. So this will be equal to 49.73, and this will be 42.42%, and this will be 0.15%. So that is how we calculate the different ratios when if we apply the standard return on capital employed decomposition. We look into now the alternative return on capital employed decomposition. Now we first of all go for the net margin for operating return on asset, that is NOPAT, divided by sales. Now NOPAT, now this is A. NOPAT for again I am going to do for the year 2015 only. This is 2809.1, 2809.1 divided by sales, that is 19162.7, and this will be equal to 14.66%. Then we go for B, net operating assets turnover, and that is equal to sales. Just now we have seen that sales is 19162.7 divided by average net operating assets. Now average net operating assets are how much? And they are here, 7322, 7322 plus 8167.3, and because this is average, so we will multiply by 0.5, or you can divide by 2, either way. So this will be equal to 2.47 times. So the net operating okay, so the net margin for operating return on assets, we have calculated this as 14.66%, and for 2014 you can calculate in the same way, 12.83%, and this will be 0.18%. For net operating assets turnover, we have just now calculated this as 2.47 times, and this is 2.51 times, and this is 2.6 times. Uh, then we calculate the operating return on assets, and operating return on assets is once again, let me clean up. This was A, this is B. We move on to C now, that is operating return on assets. And just keep in mind, I am just making calculation for the year 2015, as you can replicate for 2014 and 13 as well accordingly. So operating return on assets, this is equal to net operating profit after taxes, and here it is 2809.1, 2809.1 divided by, once again, the average common equity and the average net operating assets, and the average net operating assets are how much? The same, 7322 plus 8167.3, and because this is average, we will multiply by 0.5, and that gives us 36.27%. So that is 36.27%. And what may be interesting for you is that if you multiply the net margin for operating assets, if you multiply by this by net operating assets turnover, you will get the operating return on assets. So if you multiply 14.66 by 2.47, you will get 36.27. I will simply substitute the values for 2014. Operating return on asset, this will be 32.2%, and this will be very low, 0.47%. Okay. We go further, and we have now leverage. Okay, this is D. Number D, leverage. Now for leverage, this is average financing obligations, and the average financing, here they are talking about financing obligations. So we have the, where is the financing obligations, and over here we have the obligations 2050 and 2349. So this is leverage, average financing obligations, that is 2050 plus 2349.3 divided by, and obviously this is average, so this will be multiplied by 0.5 as well, divided by average common equity, and the average common equity is 7322 plus 8167.3, and average, so that's why I multiply by 0.5 again. So when you solve it, 8, this will be equal to 0.4. So the leverage for the year 2015 is 0.4, and you can calculate in the same way for 2014, and that will be 0.34. For 2013 it will be 0.19. Next we move on to, let me clean this first. Next we move on to number E, that is spread. Now for spread, we can see we have the operating return on assets minus net borrowing rate times net financing expense after tax divided by average financing obligations. So we have net borrowing rate. Let us calculate first of all the net borrowing rate, and the net borrowing rate will be how to calculate the net borrowing rate. That will be the net financing expense, that is 51.7 divided by the average financing obligations, 2050 plus 2349.3 multiplied by 0.5, and this will be equal to 2.4%. So this is 2.4%. For 2014 this will be 2.5%, and 2013 it will be 2%. Now we can look into the spread, and the spread is going to be let us go for the spread now. So we have the operating return on assets, operating return on assets minus net borrowing rate okay. So we have the operating return on assets. We have calculated the operating return on assets just now, that is 2809. Operating return on assets is what we have calculated just now, 36.27, that is NOPAT divided by average total financial obligations um, um, and common equity, average total financial obligations as such. So and from this 36.27 we are going to subtract the net borrowing rate, that is 2.4, that will be 33.87. 36.27 minus 2.4, that will be 33.87. In the same way, it will be For 2014, it will be 32.2 minus 2.5, that is 29.7, and this is it, these are in percentage, and this will be minus 1.5%. Okay. Next we go for a return on capital employed, and once again we have the same. You see, it will be as we have done for the spread, that is the net operating profit after taxes. So we have the operating return on assets. To this we are going to add the leverage times spread. So the leverage is, we have already calculated, 36. Now the leverage is 0.4, and the spread is 33.87. So this is 0.4 times 33.87, and we have operating leverage, operating return on asset 36.27. So 36.27 plus 0.4 times 36.27 plus 0.4 times 33.87, and this will be equal to how much? This will be equal to 49.73%. We can calculate the same way for 42.42%. So I just repeat, we have the operating return on assets. Let me clean up. We have the operating return on assets, and that is 36.27. Then we have the leverage. The leverage is 0.4, and then we have the spread, and the spread is 33.87. So when we solve it, this is equal to 49.73%. This will be 42.42%, and for the year 2013, it will be 0.17%. Okay. So this table, we can see that we have made the return on capital employed analysis by breaking it down into operating return on assets, leverage, and spread, using the data from the consolidated balance sheet, the reformulated balance sheet, and reformulated balance sheet and the reformulated income statement. Now what is interesting is that if you look into the return on capital employed, both standard and alternative method, which color should I use? It is If you look into the alternative method, for the alternative it is 49.73%, and if you go for the standard method, return on capital is again 49.73%. So we don't have the difference in the calculation of return on capital. However, the alternative breakdown of return on capital employed, it reveals that Starbucks has achieved a significant spread over here between its operating return on assets and its net borrowing rate. In the, you can see in the year 2015, the operating return on asset was 36.27, uh, and the net borrowing rate was 2.4%. So this has created, if you find the difference, this will be about maybe a 33.9%. So this means that the Starbucks has generated about 36.9 or 3% of after tax operating profit for every dollar borrowed and invested in operating assets, while paying only 2.4%, you can see, paying only 2.4% in borrowing cost. Now, this large spread indicates Starbucks' strong financial flexibility, showing that creditors are willing to lend to companies with high returns that exceed borrowing cost. Over the years, as you can see, Starbucks has increased its leverage gradually from, you can see the leverage, how much was it? For the year 2013, the leverage was 0.19. It has gradually increased from 0.19 to 0.40 in the year 2015. And in 2015, the alternative return on capital employed breakdown, it demonstrates how Starbucks has achieved a 49.7% of return on capital employed. It is calculated, you can see that the operating return on asset was 36.27, and the leverage was 0.4, and when we multiply by the spread of 33.9 as such. So comparing with 2014, this breakdown shows that the Starbucks has improved its operating return on asset. You can see from 32 it has moved to 36.27. It has, when we look at the leverage, yes, it has slightly increased. It has slightly increased, and this has contributed to the rise in the return on capital employed. Now, unlike the traditional method, the alternative approach reveals clear trends in leverage changes and offers deeper insight into financial flexibility. Overall, this alternative analysis underscores Starbucks' effective use of leverage to boost returns for common equity shareholders, emphasizing for its strategic advantage of borrowing at low cost to generate higher operating profits. So this completes the third video on risk analysis. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah, I will reply you back. Thank you so much and happy learning.